What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Teffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code FG10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show. All right, welcome back to another episode of Forward Guidance. And joining me today is the Convexity maven himself, Harley Bassman of Simplify. Harley, it's great to have you. What's going on?
Hello, good morning. Great to be here. Thank you.
Yeah, excited to have you here. I was just reading your report that you put out a couple of weeks ago on your website, and I think there's some very important components of that article that I'd love to begin with discussing on. And the first thing I'd love to discuss on is what the market has priced in terms of the Fed rate cutting cycle that we have that just began a couple of weeks ago. And first off, I'd love for you to explain this idea of these no arbitrage forward rates idea, and that a lot of folks will look at them and see that as perhaps the market implied inflation expectation. But I'd love for you to just set the stage by explaining what are these implied forward rates, what do they mean, and what does that infer in terms of where we're at in terms of what's priced in for this rate cutting cycle.
Forward rates are very tricky, and this is probably the part where you fall asleep, so please try to stay awake. If you remember the book Liar's Poker, where the Solomon guys were making all this money, this magical money machine they had, what was happening there was that they were figuring out how forward rates worked before anyone else did, and just basically taking free money off the table. Forward rates are not a prediction of the future. They're the arbitrage-free price where there's no money can be made. So a simple example of a forward rate is grandma can buy a one-year treasury for 3% or a 2-year treasury for 4%. So the question is, which one does she buy? Well, if you kind of work backwards, if you make 3% for the first year, you'd make 5% for the second 1-year period. So that total will be 4% equal to 2-year over the whole time. So basically, if you think rates are going to be over 5%, you'd buy the 1 year. If it's going to be under, you'd buy the 2-year. That's all there is. It's just a break even. So any 2 points you have, you can figure out the break even of that third leg, that middle leg in there. That's what forward rates are. Now, when they get anomalous to what you think about what's going to happen in the world, well, then you can take some risk money. So right now, for instance, what I find most interesting is look at the Fed funds futures contract listed. You could trade them. The market's kind of saying that the funds rate's going to be 3%, 295, somewhere in there a year from now, next September, October. The dots, what the Fed has been saying, ain't even close to there. So the question is, who's right, who's wrong? I tend to think that the Fed will not meet that market level, so I'd be shorting the SEP October contracts there, or doing other trades that would take advantage of that. Clearly, I could be wrong about this, but that's what's anomalous here is the market being 100 basis points ahead of the Fed, and why do they think that? And then are there trades you can put on that will take advantage of that?
So everything you just described, we can see here and just comparing the 3-month SOFR, which is just that market implied forecast that you mentioned versus the Fed median dot plots from the recent meeting. And yeah, as you can see, they both net out to around a similar terminal funds rate of, roughly, 2.9 to 3%, something like that. But the speed at which we get there is very different. So I think, there's a lot of confusion where I've seen some folks say that, the bond market is pricing in a recession. There's debate around where the neutral rate is, but if we assume they got to 3% and that's the terminal funds rate, I don't know if that necessarily means that we're pricing in a recession, but obviously we see that the velocity in terms of how quickly we get there is quite different. So is the bond market pricing in a recession, or what's it saying here in terms of the speed of which we get to 3?
It's not pricing in a recession, it's pricing in a crash landing. I mean, to go that far, that fast, things have got to get really nasty. And as far as I'm concerned, none of the data shows that. I mean, we have, GDP's cooking along at, almost 3. GDP now from Atlanta Fed is at 3 or thereabouts. I wouldn't call that a recession. Nominal GDP is at 6 almost. That's not a recession. So, could it happen? I suppose. But you really got to be rather dire to go and say that. But there's two things happening here. One over here, which we're hitting on right now, is this speed of how fast rates will go to the Fed's target level next year. So Fed thinks we're getting there in 2 or 3 years. Mark says 1 to 2 years. Okay, that's one idea. Idea number two, which I actually find more interesting than the longer-term construct, is everybody agrees, the market and the Fed, that the terminal Fed funds rate is going to be called 275. Okay, where does that come from? That comes from their belief that inflation will be 2.25, somewhere near their target, and they're going to put on a 50 basis point real rate. So that gives them the Fed funds rate at called 275, somewhere there. Traditionally, Fed funds to 2 years is 50 basis points. That puts your 2-year rate at 3.25. Okay, 3.25, somewhere there, which is where forwards already are. But 2s, 10s usually is 75 to 100. That puts the 10-year up to about 4%. I don't see how 10s go a whole lot more than where they are right now. So we can all fight about this front end, how fast it will get there, but everyone seems to be in agreement upon the back end. Unless you're going to see a flat to inverted curve out in the future, I suppose it's possible. What that's really saying, kinda, is that, the people who think that the 10's can move a lot lower than 3.5, is that the funds rate's going to 1. I don't see it happening at all, unless we hit, once again, not hard landing. I'm talking crash landing. You need a crash landing to get funds back to 1%, because that would imply almost deflation, as well as a recession, which I don't see happening.
Yeah. So if you're buying the long bond here, you're basically betting on a pretty significant recession at this stage, correct?
Oh yeah. Yeah. As we say, power windows down. Yeah.
Okay, so you mentioned a few things there around just, inversion of this yield curve. And I think this is something that's thrown a lot of people off. So here's just a chart of the 10-2s and the 10 3-month. The 10-2s has normalized back to positive. The 10-year 3-month is still negative, but starting to head higher here. This, we've been inverted for over 2 years. It feels like this has thrown a lot of people off. I want to get your take on what does it actually mean when the yield curve is inverted? Because people extrapolate their thoughts from it and say, oh, it's predicting recession. Some people even say it's partially causal. But what does it actually mechanically mean when the short rates are, basically making it, higher than the long bond rates?
I'm not a fan of the concept of it's different this time. I'm not a big believer in that. Nonetheless, you're only going back to 84 over here. I guess you kind of got to go back to the 40s and 50s to look at that, because that was the last time we had yield curve control by the government. We have not had yield curve control since the 50s or QE. QE is a massive yield curve control in essence. And I think what you've seen is the Fed has put their thumb on the scale here. The Fed owns, I think, 1/3 of all long duration securities, and the Treasury, Janet Yellen now, they've been issuing all front end bonds. Well, not all, but a high preponderance. See, this huge front end supply coming on board and a lack of supply at the back end, and the Fed owns the back end. So I kind of think to some degree the Fed has distorted the yield curve more than it should be. And my problem with all these things about QE and yield curve control, this and that, is you're taking away the feedback loop of the market to the economy, to investors, to users of capital. That is supposed to be the idea, is that the price of capital goes up and down versus the opportunities available, and the market gets a feedback loop as to what's going on. And when you don't do that, you end up with moral hazard and you end up with problems. Like I would say that the 04-06 leading into the GFC was not, I would say mostly, but highly related to Alan Greenspan's policy of measured pace. He came out and said, I'm taking rates up by 25 basis points, basically every 6 weeks, from 2% to 5%. When the market hears that, what they say is, oh, well, I know it's going to happen, and therefore I could sell an out of the money put 27 basis points out of the money, because I know he's only taking rates up by 25 basis points, and it's free money. So I can go sell optionality. I can take a lot more risk because he's told me what he's going to go and do. I think everyone got way over their skis, way over levered. So when there was a disruption in the market from housing, everyone was way over their skis and couldn't manage the excess leverage they put on. And they put it on because they were kind of swayed into this, happy dance of the Fed. We had the exact same thing happen, in this last cycle with Silicon Valley Bank and First Republic. What happened there? Did you dial back to the, dots in 2022? The Fed said via dots, rates are going to be at zero until early 2023. And they said it over and over again in dots. Well, they're not raising rates until 2023. I have no problem being long until then. They were doing massive hiking. You're way off balance. People had way too much duration and leverage because they kind of took these dots to heart and they said, I'm going to trade on that. I am, as a public policy concept, against the dots. I'm against forward guidance, as a matter of fact. I want people to go and have to go figure it out and take the risk relative to their portfolios, their risk tolerance, their capital base, and use the market to go and signal me. The more the Fed uses forward guidance and dots, they create moral hazard. It's happened twice now. I can assure you it'll happen again.
Yeah. I mean, even just thinking back to the Fed was doing QE until March 22 because they had locked themselves in because of that forward guidance, even though, they were realizing that, inflation was not transitory, but they're still doing QE at the time. Something that you mentioned at the beginning of that around this idea of it being, not explicit yield curve control, there wasn't an outright cap on the long bond. But when you compare what's been going on with what, Janet Yellen has been doing in terms of issuing bills heavy on the short end, there's been some interesting academic papers come out recently that's, calling it activist treasury issuance, and that idea paired with the Fed being, heavy on the long end in terms of what they've been doing for QE for the past, decade or so. I've personally felt like, I've been calling that like soft yield curve control. So I appreciate you saying that as well, and that you believe it that way. So my question for you is, how do we get a fair value of the long end? I know you've compared, the traditional measure of something like a 10-year being somewhat similar to nominal GDP. Is that an accurate assessment of where that fair value is, or what do you think?
I do. I've gotten a lot of pushback, especially from my partner, Michael Green. Are the charts great on this? Not really. They do follow each other or over time. So you can't trade this idea. But from a macro 30,000 foot basis, at the end of the day, I mean, the cost of money and the income have to matter. I mean, you're not going to borrow money at 6%. You can only earn 4%. But if you could borrow at 4 and invest at 6, and you could handle the mark-to-market volatility, you're going to go and do that. And we've seen basically over time that the 10-year rate, trades somewhat in sync with nominal GDP. We always quote real. That's good for academic papers. End of the day, you buy your bread at the grocery store with nominal dollars. That's all I care about. Nominal GDP is coming in right now almost 6%. I don't foresee it going down very hard anytime soon. Therefore, 10's getting below 4 seems rather anomalous to me, which kind of lines up with everything else you're seeing with market rates. I mean, the battle's all at the front end, help this early speed, but on the longer end, I think bonds are fair. I think they should be a little higher in this, but I mean, they're not the wrong price, at least not yet. And so, but this also means that the way that you can invest and make money now is a little different. And people, if you read my papers, and you're welcome to come to my website, sign for my commentary. There's 3 buttons you could push if you're a bond person. I'm a bond guy. I'm not a stock guy. Trade foreign currencies commodities a little bit, but I'm a bond guy. Duration, credit, convexity. Those are your 3 risks. Duration is when you get your money back, 2 years or 10 years, right? 30 years. Credit's how you get it back, if you get it back. Is it default or not? And the convexity is how you get it back. It's a path dependency matter. And right now with the curve inverted and with back end rates under 4, near 4, I mean I kind of think it's done. I mean I don't see you making a lot more money, at least on capital gains, promoting long duration securities. And credit, I mean CDX is what 52, 54, 55. I mean that is the tighter end of the range for investment grade credit. Are you going to blow up on IG? No, but you're not going to make a whole lot more on it either. It's at the tighter end of the range. convexity in interest rates is very interesting. The MOVE index, which I created a number of years ago, is the VIX for bonds, the implied volatility of 1 month options on interest rates. And you can see the chart over here, it's right now about 95 to 100. What's important about, and it got as high as like 130, 140, 150, last year when we had no certainty as to what they was going to do, when they were going to stop. But we're now back into the area where we kind of have an idea. The rate has peaked. They've made their first cut. Rates are coming down. Not sure how fast, but they're kind of coming down. We have a lot less uncertainty. And so therefore, convexity is very highly priced here. Why do I say highly priced? Because if you look at option prices, implied volatility for liquid instruments, equities, bonds, commodities, liquid stuff, foreign currency, what you'll see is the implied vol trades 8 to 12% over realized vol. So 1 month options, 8 to 12% over the realized volatility of the prior month. That's your best guess of where options are going to be. If you look at the VIX has been realizing 13, 14, the underlying S&P has been realizing 12, 13, 14. The VIX has been 13, 14, 15. I mean, it's kind of right there. For bonds, we have a 95 to 100 move, yet the realized volatility has been 68 for the last month. So implied vol for bonds is way too high. And that's why the trades I want to do involve taking more of my exposure in selling convexity, selling optionality on interest rate products than taking duration risk or credit risk. I don't want to get rid of it all, but I want to, in a weighted manner, I want to have a little more. Where is the convexity risk? Mortgage bonds, callable muni bonds. Those are where you have these big embedded options that are priced, as far as I'm concerned, way too high. Therefore, buying these bonds is kind of like doing a buy right, where you're selling a call option on the security. And so those bonds, I think, they're too cheap because the implied vol in the option in those securities is valued too high and is going to come in and contract, and you'll make money on those.
Yeah. So just to sum up a little bit about that is overall, in terms of the price direction of the bonds, you're fairly neutral, but the IV, the implied volatility is higher than what we've been seeing. So therefore the prices of those options are, a little too juiced. So you'd rather be on the other side of that, of selling that premium to capture it if the realized vol comes in lower than what's implied, right?
When you buy a mortgage bond or a callable muni, you're selling a big, fat, meaty option, a 3 to 5 year option. You're not doing a 1 month buy right, which is very volatile and unmanageable. And the only way you could sell these big, meaty options is by buying these callable securities. You can't do it in the listed market. There's no options that go past 6 months, really. There's a few leaps out there, but not really.
And so this idea that you've been talking about, that's some fairly complex execution for the everyday investor. But I know you've recently launched an ETF that focuses in on this strategy, and I just have this chart here open from basically explaining this. So you've had this chart around for a few months now, and it's basically showing the MBS spread versus the IG spread, and basically capturing that is the strategy. So do you just want to expand a bit on that? And also want to just hear about, why there's such a divergence here and why it isn't converging yet either.
So as noted, investors should go, the market should go and have duration, credit, and convexity roughly trade in line. You can't trade it day to day or month to month, but over the course of time, the move does follow the VIX, and MBS spreads follow credit spreads. So there's no free money out there. And you can see that for many years, the two follow each other, and they kind of blew apart in the last 2 years. This chart's a little old, so that pink line's a little lower now, but you're still talking a very wide spread of mortgage bonds over corporate bonds. And by the way, if you're going to have a massive hard or crash landing, you don't want to own corporate bonds, okay? The credit's a bad idea if you're going to have a hard landing, because by definition, a hard landing means lower earnings, which means defaults, which means wider spreads, et cetera, et cetera. Whereas mortgage bonds have zero credit risk. They have callable risk, and they have prepayment risk. There's zero credit risk in Fannie, Freddie, Ginnie mortgage bonds. If you think Fannie or Freddie is going to go down, you should go and buy guns, cans of tuna, and small gold coins because that's what life's going to be like. It's not going to happen.
Yeah.
And make sure you have the can opener in the cave. So what happened here is a few things. One is the Fed stopped buying mortgage bonds, right, for QT. But more important, what you had happened was implied volatility exploded. The move went from 50, 60 to 140. And remember, a mortgage bond is like a buy right. A mortgage bond can be modeled up as buying a 10-year treasury, this at 100, and it's like a 3-year call struck at 105. That's kind of what a mortgage bond looks like. Well, if vols double, then that embedded option is going to go and double. Also, the embedded yield curve in these mortgages, which is a little more complex, and we'll skip that for now. But a curve inversion will make that option, bigger. Because what's happened here is the value of the embedded option, which usually trades at 4 points, went to 8 points. And that's why this spread widened. So in theory, in my buy right example, ordinarily, you'd buy a 10-year at par, you'd sell an option, the embedded option in this structure, looks like it's worth 4 points. So you're buying the package at 96 points. What's happened is that option went to 8 points. So you're buying the package at 92, and therefore you have a much higher yield for the package. So far, we've come back about halfway from the highs. So maybe the option is now worth 6 points. And I will predict here it's going to go back to its 4-point value over the next year. As the curve steepens, implied vols come down. And so what you want to do is own mortgage bonds, but specifically newly issued higher coupon mortgage bonds. They're the ones that have the big meaty option because the option is near, the strike. Mortgage index product, which is what, if any of you own mortgage, unless you own my product, I can assure you, you own the mortgage index. That's all that's out there. And the mortgage index is mostly like 3% mortgage bonds because they were issued 4 or 5 years ago during QE when the entire planet refinanced their mortgages down to 2 to 4%. So the mortgage index is mostly low coupon, 2% to 3.5% mortgage bonds. Those are lousy bonds to own. Okay, they're long duration, they have lower yields, they have lower coupons. If you want to go do the mortgage trade, you buy newly issued mortgages that have higher coupons, shorter durations. Now, let's be clear. If you buy these newly issued mortgage bonds, the duration is going to be 3.5, somewhere in there, 4, something, it's called 3.5.
Yeah.
The mortgage index is going to have a duration more like 6. It's a much longer duration because the recall value is so much less. If you think we're going to hard land tomorrow, you don't want to buy par newly issued mortgage bonds because they have limited upside. Okay? In fact, you don't want to buy any mortgage. If you only believe in a hard landing, you don't want any mortgage bonds because you don't want to have, you don't want to sell a call against it and cap the upside. I mean, you want to buy long duration treasuries, which you want to buy. I don't believe that, but if you're a believer in hard landing, don't buy mortgage bonds at all.
Yeah, well said. Harley, I want to pair two things that we've talked about so far. So this idea that the long bond yields are, because the Fed has had their thumb on the scale, they're somewhat suppressed. And then comparing to what we're seeing in this chart of MBS spreads, if we want to try to find, again, this idea of a fair value of the long bond, and let's just say, the 10-year, is there a better signal in trying to basically extrapolate the risk-free rate out of what's implied in mortgage backs, spreads and that sort of thing? Or is there some sort of signal we can find and look at these two charts to understand where is that fair value of the actual risk-free rate?
I mean, I guess you're talking about R star, which gets to be really, reading mouse entrails in a cup. You got to kind of figure out where is the neutral rate, where the rate level where you have no inflation and the economy goes along nicely, people don't get fired from their jobs. People throw darts at that one. I guess now it's closer to 2.5 or 3, but it's hard to say. And then you have to give a risk premium. I think what has changed is that one, Fed's thumb on the scale, fewer long duration bonds, more low duration bonds. But also, I think people, because of the last few cycles of watching the Fed use their monetary policy to jam rates down hard if a problem happens, so basically the Fed put, in essence. And the Fed put seems to be more active now than ever, which once again, I don't believe in because I think it gets people in trouble. But it exists clearly. And therefore, what I think you're seeing now is there's a risk premium of the uncertainty of interest rates, and therefore long duration securities that can move 14, 15, 16 points per 1% move in rate. That risk is now being offset by the insurance value of if everything goes, belly up. I want an asset that's going to go in the other direction. And so I think you're seeing an offset now between the insurance value and the risk premium, which is kind of flattened the curve and probably flattened it to be less steep than it historically was. So instead of seeing a Fed funds to 10-year being 150, maybe it'll be 125 now, something like that. But nonetheless, if you think if the Fed's going to be 275, that 10 years, is 4. So, I mean, when I slice it, I have a hard time getting below 4% on the 10-year note without the Fed just really taking rates down hard. And so that's where you got to be with this thing.
Do you think there's a way to normalize things out of this mess? Like, obviously QT is still ongoing. It's been tapered, but the Fed still has MBS on their book. They've sort of mentioned that they want to get that back to zero and mostly just have Treasury holdings. But is there a pathway out of here to get back to like a more normalized world, or are we just going to be stuck here for a long time as they slowly try to unwind their lower their bank reserves off their book? But yeah, is there a process out of this?
Yes, there is, and you're not going to like it. But the real problem here is the structural budget deficit, now running at about 7% of GDP during peacetime, notwithstanding what's happening in the Middle East and Ukraine, with unemployment at 4 and change and inflation at 3 and change. I mean, these are good times historically, and to run a 7% budget deficit, it's kind of nutty. Like, what does that mean if we actually have a real problem again? We're going to take it to 15%. Budget deficit. I mean, these numbers are way too high. They've got to come down over time. I mean, these are problems, of course, that could go well beyond my lifetime. We are the world's reserve currency, the world's biggest economy, world's biggest military. So it will take a while to go and, eat through the system. But nonetheless, they got to bring that line. And the plan is this. We need to go and get it down. There's 2 ways to do it. You can default, get rid of debt that way, or you can inflate. You can bring GDP up. And that is the master plan. And this plan has been in place for over a decade. The idea that the Fed had 10 years ago was to inflate our way out of the problem. And they thought by printing all this money, they would get inflation. And the inflation hopefully would be in labor. So minimum wages would go up. It didn't work out that way. Good intentions, but unfortunately, fortunately for the boomers and guys like me, the inflation went into assets.
Yeah.
Houses, stocks, bonds, gold, art, watches, everything. So the people who had assets did well, and the people who didn't have assets did not. I think today's politics is completely a function of this massive, divergence in income inequality. And there's charts showing income inequality to disruptions in the world. I mean, the Fed owns this. I mean, they weren't bad guys. They were trying to go and create inflation to get GDP to go up faster than the debt. I think that's still the master plan. And inflation is a tax, which everyone's against taxes, of course. Even Democrats are against taxes of sorts, except for Bernie Sanders and Liz Warren. Inflation is a silent tax. Even the Republicans can go and say that because no one sees it. It just quietly removes your purchasing power. And so I think that inflation over the course of the next 10 odd years, 20 years, is the way they're going to go collapse the deficit. And it's also the way we're going to try to get around the real big demographic problem of the boomers retiring and getting Social Security and Medicare. And the big boomer generation is going to demand these funds, these income transfers from the smaller millennial generation, which is another problem to deal with over here. But that's the big pig in the python here, is basically digesting the boomers.
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Teffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup Guys Emporium edition. So you can come meet myself and Tyler and Quinn and even Mike will be there. If you're interested, we have a discount code FG10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show. Yeah, well said. And, around that is I want to talk a little bit about two things. Can we see a second wave of inflation if it's primarily driven from the Fed? And through that lens of talking about monetary policy at this stage and its actual transmission and its impact. So I have a couple charts of just, a pretty high frequency way to see this impact of Fed policy is, looking at mortgage rates. And to your point earlier in the show, talking a bit about SEPs and forward guidance is because of these, mechanisms, we can see this being impacted in mortgage rates pretty quickly before they even, start to truly cut rates. So we're sub 6.2% on the 30-year mortgage rate. And we've seen refis pick up, a good chunk, nowhere near where we were before this previous rate hiking cycle. But to that end, and this idea that, a ton of people got into a low rate mortgage and fixed it at 30 years at, 2-3% or whatever before this hiking cycle, can we really see a second wave of inflation if it's primarily through, cutting rates from the Fed side of things? Can it really impact the economy to this degree? Or do we get something like we saw in the early 2010s where we get asset price inflation, but, actual, Main Street inflation is nowhere to really be seen?
Nice charts. Don't care about them. If you look at what is the key driver of inflation here? Okay. I mean, what is the economy? It's people times hours times productivity. Okay. That's the driver of inflation. If you look back at the 70s and the big inflation we had, what was going on there was not the President Johnson, everyone's so young on this show, guns and butter. Right. This was in the 60s when they had the Great Society and they had Medicare introduced and we had the Vietnam War. So you're demanding, money into the system. That wasn't the driver of inflation in the 70s. It was the massive increase of the labor force growth rate. The boomers all turning, 25, 20, 30, getting married, having kids, wanting a house, a car, a baby carriage, demanding goods as they entered the labor force and got married and formed households, and demanding these more goods from a much smaller World War II generation, which was smaller by pure demographic, but also smaller because they were killed in the war. This is what created, and there's some great charts out there showing labor force growth versus 10-year rate, which really got tracks. What you're seeing right now, I think, is it won't be as big, but we have the same kind of curve going up of the labor force increasing as the millennials come into the market, and more importantly, as the millennials form households. Now, there's charts out there showing household formation was lagging 10 years ago behind trend. And the story is everyone's, sitting in mom's basement playing a video game and munching potato chips, which was true. It's true because the millennials get married later. They get married, 5, 6, 7 years later than prior generations. And that's why the household formation rate was behind trend. It's now catching up to trend because they're getting married. First child in San Fran is 32. First child in New York is 31. These are much later numbers than what we used to have. And as these millennials have their kids and get married later, they're going to demand houses, goods, cars, baby carriages, all the other stuff. And they're going to demand it from the boomer generation who is retiring earlier than expected. And I have that chart in one of my commentaries numerous times about how the retirement rate for boomers is well above trend. Why? Because the Fed jammed up asset values. We have all the assets. So when we kind of cut out in COVID or just looked at the market and said, you know what, done. I'm going to go travel. I got plenty of money in my 401k now. My house is worth a bloody fortune. I can tap that. Why work? And so the boomers who are very productive and efficient, they're retiring faster. Supply reduction, increase in millennial demand. So I see that as it's not going to take inflation back to 9, but it ain't taking it to 1 either. So if we have inflation cooking along at 3, it's a hard time once again to go and see rates really come down a lot after the Fed to take rates down by a lot. So that's my demographic story on that.
I mean, it sounds like, those are much more entrenched trends versus, this debate of whether the Fed goes 25 bips or 50 bips at a given meeting. It seems like we're heading into a world of secularly higher inflation, regardless of really what the Fed decides to do in terms of, cutting 25 or 50.
Yeah, and so if you have inflation of 2.5, 3, and you have GDP of 2.5 and change, like you're talking nominal of 5, 6, which, by the way, that's a good result. Nothing wrong with that.
Yeah, it's too bad we don't have your colleague here, Mike Green, on here today. But you guys have both had some great debates around the recession versus no recession. I know he's more into the recession camp and looking at some of the aspects of the labor market deteriorating versus how you're seeing things. But given what we just talked about in terms of these changes, in terms of labor supply growth, where do you stand on that today in terms of what are these things that Mike is seeing in terms of labor market deterioration that is also spooking the market, and the Fed is talking more and more about labor market cooling?
Okay, don't go crazy, people. I don't like talking politics. Well, but immigration. You could be pro, you could be con. You could be let them all in. You could be form a line. You could be lock the door and put machine guns to block it. I don't care what your policy is. There is a result of that. The result is, remember, what is the economy? People times hours times productivity. If we have less immigration, we will have fewer people, period. These immigrants mostly work, right? That's why they're coming here, to go and work minimum wage jobs. That's a good result from GDP, from inflation. Keeps wages down, keeps GDP up, keeps money. And are they paying taxes? Maybe, maybe not. As far as income, I don't care. They are paying taxes, sales taxes, right? They're paying property taxes. They're living someplace, so the guy who owns the house is paying property taxes, which is the source of most state revenue, is property tax. It's only like New York, California, where you have a huge income component. Florida and Texas, it's all property taxes. So you're going to have less inflation, higher GDP with more immigration. If you want less immigration, that's okay. I'm not going to argue with that. I'll just say you will have more inflation, lower GDP. That's the cost. And same thing with tariffs. You want to go block China or other countries from sending in their goods and other things. Once again, if you want to pay a higher price, and maybe it's worthwhile from a national security idea, value chain, supply chain, all those things, that's okay. There's a cost, there's a benefit. Just don't think it's only one side of the equation, okay? And probably it's a good thing to go and to push back on China to onboard more stuff in this country, to go and sop up the people who are being displaced by technology. That's probably public policy good. But once again, it's a tax across the board for everyone. And where's the right number, the right mix? That's a harder question. But just remember, immigration is a cost-benefit calculation, and you are free to go make it however you want.
If we look at what's being priced in corporate credit right now, it looks like, if you look at spreads of investment grade or high yield, those spreads are a lot more in your camp of no recession. Do you feel like, credit spreads are fairly priced at this stage? When you compare it to something like where the unemployment rate has been going and those sort of signs, credit spreads are tight. Do you think they're fairly priced?
No, not at all. They're not crazy the wrong price, but you have very little, insurance against bad things happening, particularly at high yield. Look, all the companies, it's the same chart you see over and over again. I'm not plowing new ground here. We saw all the corporations refinance, 4 or 5 years ago. Usually it's 5 to 7 year paper. We've seen the wall of maturities coming up starting next year, and then really getting bigger in 2026. And the question is, can these companies refinance at all? And if they can, what will their earnings be like when they're paying, 7-8% as opposed to 5-6%? What is interesting, Albert Edwards has posted this chart a few times, as well as other people, I'm sure, is the net interest for S&P 500, large company, IG companies, is actually positive now, which is insane. How can your net interest expense be positive or negative expense? Because these guys all took in tens of billions of dollars on fixed rate loans at 2-3%. They're now investing them at 5%, because they just took the money in just because they could. So they're actually earning more than they're paying out, which is anomalous. Which kind of basically tells you the Fed's ability to apply the brakes or the accelerator via the interest rate they set, not the QE component, but the
Hmm.
rate they set, has been massively reduced. Homeowners
Yeah.
totally, fixed out their loans for 30 years. I mean, mostly they don't care. Now, credit card people, the lower income, they're getting hurt. But the guys where most of their debt is house, they're fine, man. They have a profit even. When you think about the bond, I mean, in theory, the bonds they created at 100 are now trading at 85.
Hmm.
Corporates, same thing. They trimmed out their debt and they have plenty of cash. So the front end has much less impact than it used to up and down. QE can be different, of course.
That's a super important distinction, just around the relative muted impact of these rate changes because everybody's just termed out in fixed rate debt. One thing I wanted to ask you about is looking at especially the stock performance of these equities of the mega caps over the past couple of years that were able to issue much longer duration versus small caps where the percentage of, say, the companies in the Russell 2000, a lot more of them are in floating rate debt versus fixed rate. So do you see an opportunity there in terms of positive tailwinds towards small caps as we're seeing rates come down now because their floating rate debt has a lower interest bearing now?
I mean, what? I mean, they're not that levered. If they're investment grade companies, fine. It's a little better income, but not much. If you're high yield, they have a credit problem to deal with because those spreads have widened out significantly from back. The overall package costs more now because back then people were desperate for yield. When you had a 0% funds rate, people will do anything for yield. You can get even 3-4% on the front end treasuries. Like, what's wrong with that, man? That's not a bad number. It's not 5, but 3-4 for zero risk is fine by me. So I'm not impressed by that. Once again, I'm more interested in selling optionality, selling rate uncertainty, than taking duration or credit risk.
Yeah, well said. So, maybe we can wrap up there with just asking if there's, obviously you have the MBS trade and ETF that you have there, but is there any other major opportunities you're looking at in the fixed income space aside from that, or is it mostly just looking at ways to sell vol in these idiosyncratic ways?
Um, Mortgage REITs are interesting. Be careful because mortgage REITs is basically my product, but levered 7 to 8 to 1. Um, I mean, a lot of these trades matter on how fast the Fed's going to cut the front end down. Because all the levered companies, when that rate comes down, that just turbocharges on through. The same way on the way up, it turbocharges them south. So I think those are interesting. Um, I suppose, I mean, I'm a little early on them if you buy them now, because as I said, I'm a believer this can be a slower path to lower rates. But I'm okay with mortgage REITs and things like that. The stock market, I think it's fine. I mean, it's going to go up less than it has historically, just because we're starting at a higher PE. But I'm not convinced about a crash. And I don't see what Plan B is for this whole concept of the U.S. dollar, losing its privilege of being the world's reserve currency. Okay, fine. We've done a lot of dumb things and we have bad this and bad that, but where's Plan B? I mean, it ain't China, ain't Russia, ain't Japan. Maybe Europe, kind of, but not really. Like, there is no Plan B unless you're going to go to gold or back to rocks and clubs. I mean, we're a financial world now, and the U.S. runs it. And I would say that maybe an important consideration is ways that we can go and maintain our, I don't want to say dominance, but basically control the world. I mean, the U.S. We have the world's reserve currency that we can print, and as long as we maintain kind of security in the world and the rule of law, what we've earned is the right to set the rules for the game, and we like that a lot. As long as we can maintain that, where we control the banking system, we control all the pipes, we control everything else. That's a good thing for us. Not as good for everyone else in the world, but a good thing for us. And I don't see that changing anytime soon, almost no matter who wins.
Do you think that we could see further upside in equity markets? Like, do we need to see higher long bond yields at the same time? I know you've talked a bit about how, those two markets are pricing in quite different things. Or could we see further upside in equities with the long bond yields either being where they are, even potentially, rallying?
If you had rates go up a lot, you'll see stocks go down.
Mm-hmm.
They'll go down because what is a stock? You're getting earnings over the next 30 years. You have to discount that back at some rate. I'm a U Chicago, nerd, so I still believe in value, notwithstanding what's happened with the Mag 7. And so much higher rates would be bad for equities, but a little higher is not going to matter. A lot lower, I suppose, would be good for equities, kind of, sort of, except for the small detail. If we get rates a lot lower than here, that means we're talking 1% funds as opposed to 2.5%. And really doing that if bad things happen to the world. So that's bad things happening is not good for equities. I think equities can do fine. And moreover, equities are priced in nominal dollars for nominal earnings. As I said, if the master plan is consistent low-level inflation, that if we have nominal GDP going 4, 5, 6, then you're going to have stocks go 4, 5, 6 overall. Maybe they'll lag a little bit as the PEs compress and widen. But I mean, the master plan here is to increase nominal GDP to reduce our debt to GDP ratio. And since you're buying assets in nominal, that's a winner. If you go look at Weimar, Germany, when they have the massive inflation, people with wheelbarrows full of money, at the end of the day, if you own stock, you own equity in the big companies, you did fine, because the value of the company really didn't change in nominal dollars. If prices doubled, then they doubled their wages and doubled their prices, and they still made the same amount of economic real income. Stocks are a fine long-term hedge for inflation. I'm talking very long-term, not a year or two, but over the course of time. Stock market will follow nominal GDP, because what's GDP? It's the country's income. In closing, what I'll say is this, and I say this in all my commentaries, sizing is more important than entry level. Do not try pick the bottom or the top. You're not going to do it except by accident. What you want to do is pick an idea that you like, that you believe in, for whatever reason that might be, size it large enough so if good things happen, it'll impact you in a positive. You'll feel it, okay? But small enough so that if you're dead wrong, it won't wipe you out. You won't get stopped out. You don't want to get so over your skis that if a bad thing happens, you're forced to sell. If you look at the companies that really got rinsed in 2020, it was the ones that were over levered and were forced to go and check out, sell their assets, reduce their leverage at the bottom in 2020. Every other company came back fine. The ones who were over levered got cooked. And you don't want to be in a position where you have to go and liquidate an asset on a short-term bottom. So do some, career planning, some life planning, and invest accordingly. And then, of course, travel with your family. Okay, I mean, you're born, you live, you die. You're dead for a very long time, much longer than you think. So spend time with your kids.
Very well said. What a great way to end that, Harley. Look, love chatting with you. Where can folks go that for some reason have not read your writings or heard about Simplify?
I work at Simplify Asset Management. We are a very, very clever company. What we're doing is we're the leaders in taking derivatives, professional investment products, and putting them into listed ETFs. This is a very new thing. It's only been recent because the SEC changed the rules, and that's what we do. Is we put these clever ideas, futures, options, total return swaps, all these other various things that an ordinary civilian cannot do. We put them into ETFs in a liquid, listed, low-cost way. And so that's kind of why I came out of retirement, because I'm a derivatives guy. Bigger picture, my site is convexitymaven.com. I have my email there. I publish every 4 to 8 weeks. If you want to get my publications, send me an email. I'll add you. It's all free. And I have a section called the Maven's Classroom. That's where I kind of stored a bunch of my commentaries that are timeless, talking about convexity or credit or things like that. So that's a good intellectual, educational place to go.
Awesome. Well, thanks so much for joining, Harley. That was really great.
Thank you.